you're entitled to a portion of profits for doing the deal and making the investors the money. You gave them the first 8%. You've probably been doing that a little bit. Now there's extra proceeds. And that's where you as a sponsor can start to make, a percentage of the profits on that deal. Welcome back to How to Invest in Commercial Real Estate, guys. What is up? And today is all about the waterfall structure. So waterfall, just fun facts to know and share. A waterfall structure is what you're doing with the cash flow. Nothing above the cash flow line. Just you raised money on a deal. You went and bought an investment deal, and you have cash flow you're distributing to your investors, and you're distributing that through what's called a waterfall.
Okay.
Super
Tell
easy.
us about it, Brian.
Well, a waterfall. Waterfall is how you distribute the cash, who you distribute the cash to. It's a legal description. It's going to be in the operating agreement typically.
Yeah, so generally speaking, when you're getting in these bigger deals and you're getting into bigger types of investments, you've already established you want to invest in commercial real estate, yada, yada, yada. It's less important how much you own of that entity, right? So when you're putting a financial package together, when you're pitching an investor, you're not going to them and saying, hey, I'm soliciting, an investment for $100,000, we're raising $1 million. You're going to own 1% of that company. They don't really ask that. When you're going to an investor, the investors don't ask. I don't know if I've ever been asked, what is my equity percentage going to be? Because it's kind of irrelevant.
They're less concerned about that, but this is the question you're going to get. Is the investor gives you an investment of, let's say, $100,000, they're going to ask, okay, tell me how I'm going to get my money back, or how I'm going to get returns on that $100,000.
So if you could describe a waterfall structure, it was exactly what you just said. How am I going to get paid?
Yeah.
What are you going to do with the money once you earn it? So that's what it's about today. We're not focusing on how you're earning the money. The commercial real estate earns money. We've established that. We're on episode 14, 15, something like that. And the commercial real estate property makes money. So it's just how we're distributing it.
Now, what are you going to do with that cash flow?
Yeah. So what's, a common one? What's just an easy structure that we can start on a popular waterfall?
So there isn't a standard that applies, but there is a I would say maybe there is an industry standard, but it's general and it's flexible. But typically investors want a preferred return. Okay, so we'll define that for you. A preferred return, when I give my investors a preferred return, it means that I'm going to pay them a certain percentage on their money before I participate in the cash flow split.
Mm-hmm. Right.
So on our deals, we do a lot of 8% preferred returns. I've seen them 6, I've seen them 10, but 8% is probably an average. And so if we have cash flow, I'm gonna try to pay the investor 8% on their money, prorated maybe on a quarterly distribution. And only after then do I get to participate in a cash flow split, which is part of the waterfall.
As a sponsor.
As the sponsor.
Yeah. So the investor, that's a easy marketable thing from a sponsor to an investor. Hey, I want your investment. I've got this great commercial real estate deal that I think you should put the money in. I'm putting some money in it as well. And the limited partners or investors are getting the first 8% a year that property makes, the first 8%. And then after that, you may get into what's called an equity split or, a profit share or something like that.
Yeah, and it's sometimes called a promote for the sponsor. And so how much of the cash flow do they get after the 8%? And it can range. We've done deals at 25%, 75, which means 75% of the cash flow over the 8% goes to the investor. Right. And we've done them as low as 50% of the cash flow after 8% goes to the investor.
So why would you do that? Why are you splitting up the profit shares now? As a sponsor, right, I guess you're entitled to a portion of profits for doing the deal and making the investors the money. You gave them the first 8%. You've probably been doing that a little bit. Now there's extra proceeds. And that's where you as a sponsor can start to make, a percentage of the profits on that deal.
And it's market driven. Brian, you probably can speak to this because you've invested and I've pitched you some of these deals, but investors are more interested in the returns that you can deliver to them than they are on the structure. Now they're going to be sophisticated guys. Let's say they're private equity money or family office money that can write $10 million checks, and they're gonna dictate the terms to you. But when you're just raising funds from friends and family and coworkers and things, they're more interested both in you as the sponsor and in the return that you're going to give them. So for us, we were doing high cap deals, maybe slightly more risk, so the returns were better. And so we say, hey, we're going to give you the 8% before we touch it. But if the deal is, let's say it's 16% total return, cash on cash return, then I can give the first 8 goes to the investor, and then we may split what's left 70-30 or 60-40. And so let's do the math easy. Let's say it's 50-50.
Right.
Then
you have 16.
Yeah, we have 16. So the first 8% goes to the investor, and then the second 8% gets split up 50-50. So 4% to the investor and 4% to me as the sponsor. And so that the investor is getting a 12% cash on cash return. And if there's enough cash flow, I'm getting 4% of that cash flow, or a quarter of that cash flow.
Yeah, I think you're right. I think the first thing that catches their eye is if they see that they're going to get, I don't know, 12% cash on cash, then that's what gets them interested. And then of course they look at IRR maybe, but then I think most people will see, well, how is that? They'll dig in and they'll see how that structure, how that waterfall is working.
Yeah, investors always ask, whoever they're giving money to is, what's in it for this guy? How is this guy making money? How is he making money off of this investment? What's in it for him? And as a sponsor, you've got to be able to look your investors in the face and write it in legal documents, write it in your private placement memorandum and operating agreement where the money is going. And you've got to be able to tell these guys, after I paid you 8% in that year, and then the property is going to make another 8%, you're going to get 12% that year. Yeah. It's not a bad thing that I'm only getting 4%. You know what I mean? And giving them that first 8%, there's a lot of, and it can be whatever, right? Like if you're just getting started, you may give your investors the first 10 or 12% because it's, you're looking at higher yield deals maybe, and you need to give your investors some more money.
Once again, it's market driven. So if your investors have a better investment that they think is safer, they can earn them more, then you're gonna have to give them more of the deal or a higher pref in order to get them interested in your deal. So that's just how it goes.
So I've got a question for you. So is waterfall just on the cash flow? Is the waterfall part of the, what about when the property sells, the asset sells, and there's a capital distribution? Is that part of the waterfall also, or is that even called a waterfall, or is that something completely different?
Yeah, it's definitely called a waterfall. You've typically got 2 different sections. You've got a waterfall for distributions during operations. You're going to go in and buy this asset, maybe hold it for 10 years before you want to sell. So during that 10 years, you'll operate under the operational waterfall.
Right.
You'll also have a recapitalization waterfall, which means if there's a capital event such as a sale or a refinance, then you follow that waterfall.
I see.
And what's more common in those is you pay back all of the equity and then you go to a different profit split.
Yeah. Okay. So I thought that it might even be required that all the equity gets paid back first and then to a split.
Here's the beautiful thing about it. The operating agreement, the private placement memorandum, and the waterfall, you get to write.
Yeah, you write it.
You write it.
However
your
you write
attorney
it,
writes
that's how it is.
However you write it, that's how it is. It's the rule book. It's the Bible of the investment, whatever you want to call it, whatever you want to refer to it as. We write it. We make up the rules. It's market driven, like Joel's saying. It's 100% dictated by your investors in the market.
But it's probably not too common to take a split before the investor's equity is paid back, is it? At the end, at the capital event?
I would say on a capital event, it's typically not. I wouldn't take a split before they get all of their capital back.
Yeah, right.
Now, some sponsors that if they're maybe they got strong armed by a private equity group or whatever, they'll do an 8 pref. And then anything over the 8 pref goes to pay back the capital.
So let's use that same example. The property's making 16. They're paying an 8 pref. Anything over that.
Okay, so then anything over that 8 pref, let's say it's another 8%, that goes to pay down their capital. Okay, so now they only have 92% of their initial capital in.
Which also means the pref is going down.
And then the pref is going down because then the next year I'll only pay an 8 pref on the 92%. And then I'll give them the other 8%, which it goes down to now 84. And so you work that capital balance down, and only after that capital is paid 100% paid back does the sponsor in that scenario share in the waterfall.
Yeah.
Right. Okay. And there's some important terms, and I don't want to get too in the weeds here, but it's important when you get into waterfalls, you're distinguishing return of and return on investment.
Yeah.
right? So a preferred return, that first 8% that you're giving them is probably a return on investment. You invested something, and this is the return that investment made. A return of investment is giving you your original money back. So you have to be able to distinguish that. And it's important that if you're doing it like we just described, where you're paying an 8% promote or whatever, and then anything above that the property produces, you're paying down the investor capital, that they need to be aware of that. And that needs to be written in the business plan from day one, right? Because that would be a different structure than somebody saying, hey, I'm going to hold all of your money for the entire 10 years, as opposed to, because that preferred return's going down. In year 7, you're probably going to have 50% of the investment left in the deal, and you're only getting 8% of half of your investment. So you need to know what you're going into, and you need to know what the market is driving and what your investors want.
And so I'll give an example of how we do it, just so people know what Precision Equity is. We typically do an 8 pref, and then we do some split of the cash flow over that. Let's call it 60-40, 60% to the investor. So we give the first 8% goes to the investor, then 60% goes to the investor, and then Precision takes 40.
Anything over the 8%
is split 60-40, and that's how we address yearly cash flow. And then if there's a capital event like a refinance or a sale, then as long as we've paid at least the 8 pref through the whole holding period, then we pay 100% of the capital back, and then we split 60% to the investor and 40% to Precision Equity of the profit that's left over.
Yeah. Okay.
Yeah.
But the split could be different, right? For the cash on cash over and above the pref, the split could be different for the cash on cash and for the capital distribution, right? Or is that usually the same?
I think it's usually the same. There is a situation where, and it gets a little complicated on calculation. We try to keep it simple, but let's say it's an 8 pref, and then it's a 70-30 split, and until I get the investor to 12%, and then it may switch to 50-50.
Oh, okay.
And so you're basically, you always want your sponsor's interest to be aligned with yours. That's why the pref makes so much sense, is that, hey, they don't get to participate in any profit until they at least get me 8% on my money.
Yeah, because why should they? If you're promising them a 12% cash on cash return, I don't want my sponsor really making anything until I'm getting pretty close to that, what you pitched me, right?
Yeah.
And another really good point, I think, is that these can be as complicated and as simple as you want them to be. Like you said, you can say, hey, they get 100% of the cash flow up to 8%, and then it's 70% of the cash flow up to 10%, and then it's 50% of the cash flow up to 15%. I mean, you can do this forever and ever and ever and ever. At the end of the day, you're going to have to write it in the docs and explain it to people. And people have, sophisticated guys, and even us, you can go through these and it can get complex really fast because there's so many entities, there's so many splits. It's a lot to keep track of if you're just now starting. So I would highly suggest to get something that your investors can understand and digest. Like, don't do an IRR hurdle on your first deal. That's so complicated for your first deal, and your investors aren't going to understand it. And what people don't understand, they don't invest in, guys.
Yeah. I agree.
Our first couple of syndications, we did a straight 75-25 split with no pref. Now, I still got some people to invest at. Now they want a pref. They're used to a pref. But back then, that was as simple as it was. If the property made money, then we just gave 75% of that profit to the investor, and we kept 25 as the promote. So it can be really simple.
Yeah, I agree with you. If people look at that and they just don't quite understand it, they don't want to put their money towards something they don't understand. It's kind of like when I go gambling, I don't understand craps. If I do craps, I'm just going to be throwing my money away because I don't understand it.
Yeah.
So, yeah, you're right. They're not going to invest if you make it too complicated.
Yeah, and another big thing is ask questions. I know we did a whole episode on asking questions and, asking bigger questions or whatever, but you need to be going out to people who are raising money or doing deals or investors and just ask them, hey, would you be interested in something like this? If I could find you a great commercial real estate deal and pay you the first 8% a year, would you be okay with me taking 30% of the profits above and beyond that? And I should still be able to get you 12?
Yeah.
What? You should be able to have that conversation with some people.
Yeah.
And if you can't, you're not going to be able to raise the money.
Yeah.
So you've got to start understanding it. You've got to start getting comfortable with it. You've got to start talking to people about it, and then it will become.
Yeah, but you shouldn't be shy about about it because the fund manager needs to make something. So, I mean,
Absolutely.
he's got a lot on the line. So, shouldn't be shy about saying that, well, I'm going to take some of the split. The fund manager is going to take some of the split over and above the pref.
That's a really good point. Don't be afraid of getting paid for being a sponsor. You know, we want to encourage people to get in this game. You know, for me, we've made a lot of investors a lot of money. We've paid distributions above market, I would say, for the last 10 years straight. And yeah, we've sometimes taken a little bit more of the back end profit over the 8 than maybe some family offices would let us or some private equity would let us. But the idea is that I'm delivering good investments for the investors, and the investors should want the sponsor to be motivated. You know, just like right now, we haven't pitched a deal in the last year because they're hard to find. And so you want your sponsor to be motivated to bring the deals to you, as long as they're making good returns, because otherwise your money's sitting,
right,
or in the stock market waiting. So
good point.
We had a really good conversation yesterday with Andy over at the Woodmont Group, and it was just this discussion because we funded this Kitty Academy, and that Kitty Academy was I think it was an 8 pref and a 60-40 split, which may be 40% sponsor split on the back end. Some people could balk about. But at the end of the day, when you're doing a deal that can justify, it can get me all the return I want as a limited investor with an 8 pref and a 60-40 split, all the return I want, and he can still take 40%, I'm like, good job, dude. I don't need to be chasing deals that have like no split left to work with, and the sponsors, not making any money because the deal is barely getting the investor what they need. If the deal is great, then the sponsor maybe should take a little bit more on the back end, and that's okay. And I would like that deal.
Yeah, that just means that the sponsor did his homework and his or her homework and found a good deal.
And it may just be a really good deal. Exactly.
Yeah.
Well, good. I think it was a broad coverage of how to structure the deals and the waterfalls. There's an unlimited way to do these, but you just got to ask questions and kind of find out what others are doing.
Absolutely. Well, we'll be back in a few days with the next episode, but thanks for watching and listening, and make sure to check us out on the web, howtoinvestincre.com. Thanks, guys.
All right.
Thanks.